Righto, money miners, the Christmas countdown is on. 2 weeks to go, but we ain't stopping now. We've got an Iluka Eneabba deep dive spectacular today, you boys. It's all happening, all right?
It's one of those stories, Ali, that just makes me angry, mad, disappointed, frustrated.
All of the feelings.
A lot of feelings, yeah. Just it's a head scratcher on a whole bunch of levels, which we're going to get into. But yeah, one thing that maybe didn't make you unhappy or us unhappy was your weekend. How was your weekend, Ali?
It was good. So I was at the CBH over the weekend. So for our non-Western Australian listeners, that's the Cottesloe Beach Hotel, right in the heart of the infamous 6011. And I was waiting in line for a drink at the bar when I saw something very peculiar on the back wall, which I didn't think to see. So here's a picture. Can you guys spot it?
Am I looking at a hat with a little blue logo on it, Ali?
I think that might be the one.
Wildcat.
There was a wildcat hat on the back of the bar, which is you'd only see that in the 6011, so I love that. But there's actually something else in that picture. So if you take a closer look.
Look at that.
It's Druba having a schooner. So Druba from Cadrill, he can meet up with you anytime, anywhere in the 6011 or beyond to help sort out your 2025 drilling contract with Cadrill. There's been a bunch of ASX small caps. We've been seen doing heaps of last minute raises for the year to sort of set themselves up for a strong start to 25. So to all of those companies, make sure you've got Ryan O'Sullivan and the rest of the Cadrill team up at your site in the new year, punching RC and diamond holes.
Ali, it's like Cadrill's colours are red. It's Christmas. It's Christmas theme. Yeah, you got Rhino doesn't take a break over Christmas. He's punching RC and diamond holes through Christmas. He's punching them every day of the week. He punches them in his sleep.
So make it your New Year's resolution to get Cadrill up on your site punching RC and diamond holes. Get in contact with Juba. His details are in the show notes.
Thanks for your support, Cadrill.
Go Cadrill. Alrighty, let's talk about Iluka Resources, guys. This was a big one on Friday. The funding package that has been sort of long negotiated between Iluka and the government came through and the market did not like it, down 10%. So
wow.
It was fascinating, right? The call had a lot of interesting questions, analysts trying to piece through. The call was put on at relatively short notice with a lot of info, a lot of assumptions baked into it, a lot of footnotes that you had to go and read. So we've got plenty to chat about on this one.
For context, JD, like what is like the background to this whole Eneabba rare earths facility and the funding package with the government?
Yeah, let's give a bit of a recap on everything that's kind of happened because it's been a few years in the process now, right? So in early 2022, you had Iluka pressing go on the Eneabba rare earths refinery to the north of Perth in WA. Now, final investment decision was taken with the aid of a $1 billion and $50 million non-recourse loan from our government. So this was done through the government entity of Export Finance Australia. Now, Iluka at the time would contribute $200 million plus the Eneabba stockpile. So that is a stockpile that had been building for a number of years, goes back quite a while now. So this refinery, importantly, would be designed to handle not just the Eneabba stockpile, but any other Iluka feedstock. So we've got a few projects in the works, which we'll chat about there, plus potential third-party feed.
That was It was interesting at the time. I don't know if too many people were expecting this FID. It kind of just popped up out of the blue, and I think it popped up the week before the standing government went into caretaker mode. So kind of go figure. And the whole the loan that was provided at the time by the Australian government was so the terms were so out of market with any concessional finance that had been kind of provided at all in any critical minerals area whatsoever by a mile. It was kind of remarkable. A $1.05 billion non-recourse loan. Terms were sweet as all hell. Yeah. Didn't have to repay it for forever. It was just everything was honky dory about it. But interestingly, at the time when they did announce that FID, they talked up the prospects of also being able to process their some of their deposit at Wimmera through this rare earths facility as well. Wimmera, the Wimmera project is one of it. They've got a bunch of these WIM style deposits in their portfolio. They're in Victoria. They were actually kind of delineated by Conzinc back in the 80s. They haven't been developed yet it's been a long time, right? But they haven't been developed for a few big reasons. The first one is incredibly fine, which makes separation of the zircon really, really challenging. And the other one is that they've got high levels of impurities, which makes purification of a saleable kind of zircon product really, really challenging. On that first point, Iluka, they figured out a solution to separate the zircon in 2018. But the second point on the impurities, they've done some kind of purification or zircon purification in a lab, but they still need to prove it up at sort of scale, and they're doing a demonstration plant now. But there's no guarantees though, and the attractiveness of those WIM style deposits is actually, they're high zircon grade. So despite all this and the challenges to actually get a saleable kind of zircon product out of it, Iluka, they did put a reserve on Wimmera in 2022, and that assumed they would mine it, sell the kind of lowish value ilmenite products, produce a rare earth concentrate, which would go to Eneabba, but the zircon product isn't assumed to be recoverable for the purposes of the reserve there. And you fast forward to Friday's announcement, we get a bit of an indication of how Iluka might actually be thinking about its feedstock options here, because in the interim since they announced FID, a few things have happened. They did a deal with Northern Minerals in 2022 to try and get some supply from their Browns Range project to feed the Eneabba refinery. They also progressed their Balranald mineral sands project in New South Wales, and hence the scenarios that Iluka actually put forward on Friday were impacted by these developments.
So, Trav, what are the sort of three scenarios that Iluka have put forward now in the context of all those, what they had and those recent developments in the last few years?
If you look at, you can see the pictures that they show here. So three scenarios. One, just 35-year life, underutilized refinery, because they're only assuming that it's using Iluka's Eneabba stockpile, Balranald concentrate from Balranald, and Wimmera concentrate as well. The second scenario is the same as above, but now they throw in Northern Minerals. But look at what happens when they include Northern Minerals as feedstock. It actually displaces Wimmera to later in the refinery's life, and I think that's telling personally. And then the last scenario, they call this the financing case, which only processes Eneabba stockpile and Balranald, no Wimmera. So just look at those three scenarios of change. I think there is a read-through that there are doubts about the economics or timelines or both of Wimmera, which makes a pretty big impact when that was kind of, your big baseload, long life part of the feed of Iluka's.
And Trav, explain to me and probably the other money miners who aren't as clued up about mineral sands and the rest of it and rare earths. Balranald and Wimmera are mineral sands projects. So why are they getting talked about in the context of a rare earths being feedstock for a rare earths refinery? Is it some sort of byproduct thing?
Exactly.
Or how does that work?
Yeah, when you're processing mineral sands, that you oftentimes a typical byproduct of that process is a monazite concentrate. That monazite concentrate is oftentimes rich in rare earth elements, which if you plug it into a refinery, which is you're cracking and leaching, and also a hydromet plant, you can get some separated rare earth oxides out of it.
So to round out on the assumptions put forward, the key point of the negotiations happening over the last year is because the capex blew out. So initially that was pinned at $1 to $1.2 billion, hit a stumbling block in late 23, blew out to $1.7 to $1.8 billion, with $320 million of that money being spent to date. So you had a bit of a stalemate as Iluka and the government battled over who's going to chip in and fund the rest of it.
And to clarify, guys, this capex relates to this Eneabba refinery. So any capex to bring online this Wimmera project, which I think is currently at DFS stage, that would be in addition to that, right?
Yeah, Wimmera's capex is not insignificant.
Separate.
It's I think their sort of PFS assumptions nearly $1 billion there from my memory. So yeah, that's they're actually, this is exactly right. That's not included in this. It's
Purely
this is just the refinery.
Yeah.
And so that brings us now to last Friday's announcement. So what's been the funding update that's come through recently?
So to get them there, EFA are going to contribute $400 million on the same terms as that 2022 agreement. Then you've got Iluka adding $214 million in cash equity. That includes $82 million for working capital once the plant is built, but you're waiting for that first cash flow to come in the door. So in total, from an Iluka perspective, there's another $300 million that needs to go out the door because
From their pocket.
because that initial $200 million is not all yet spent. So just looking at the, in simple terms, the amount of money going forward versus the proportions that were paid up in 2022, Iluka is contributing a greater portion. And if you start to look at how cash flows are going to kind of be distributed, it gets pretty interesting. The annual interest charges, so like you said, Trev, super friendly, but we won't go through the full waterfall, but you still need to pay that back. And there will be an annual interest charge of about $116 million per annum on the fully drawn debt plus accrued interest. That doesn't leave much cash flow from the sweep in the first 4 years. So that is just using the stockpile scenario, that scenario C, as we showed in the chart just before. And that's also making a big assumption, which we're going to talk about a good bit, that the ramp up goes smoothly. We've said it many times in the past, rare earths processing are just not simple by any stretch of the imagination. And I think you could almost comfortably take the other side that ramp up is going to be a smooth process here.
Yeah, well, that's the interesting point, though, right? Is like it is a big interest rate, and you do have to pay that back. But keep in mind, this loan is non-recourse, so it's like to the extent the Australian government has a claim, it's I think it's limited to that refinery code. It doesn't extend to Iluka's other assets.
Yeah, which the management are keen to point out, and I think one of the analysts sort of called it, in a sense, it's an option on rare earths prices ticking up because you don't have that recourse to the rest of your balance sheet.
Yeah, I described that tweak to the funding. It's kind of like, there was this relatively kind of commercial adjustment which allowed for more money to go in, but it wasn't skewed entirely in the government's favour. But it was you're making this commercial adjustment on an already kind of completely out of market concession.
It was so friendly to put it lightly. It was order of magnitude above any of the other checks we've seen written in Australia, at least. The US, they throw about a fair bit of money. To just round out on that funding piece as well, there's a $150 million cash overrun facility. It's worth mentioning because we've already seen a not insignificant uptick in the capex. So that would be split 50-50 between Iluka and the government. And then there's an important caveat as well. That additional funding is subject to offtake agreements that the Australian government is happy with, reading between the lines, not China. So there was a good question that was asked about this in the call that happened right after the announcement from a UBS analyst asking, where will the buyers emerge from? And it's the right question to ask. So Iluka came back and said there's a number of EV manufacturers around the world, looking at Korea, looking at the US. There'll be a range of markets that we can sell into. But, really thinking about who is going to buy this? There are no industrial buyers in Australia of this project. And the company...
Of the product from the project, yeah.
Yes, yeah, that's right. So the company said we're going to come out and announce these offtakes closer to the completion of the plant build. But just looking around the world, right, you've got China, we can't sell, but that is 85-90% of the market. Then you've got Japan. Japan is wrapped up by Lynas. Lynas do everything they can to sell into Japan or sell into Vietnam, which is kind of Japan-owned facilities there as well. Plus you got MP Materials, the US rare earth maker, who are very eager to sell into Japan too. Korea and the US, they're just not there yet. You'd be making a big assumption that their markets grow as you build this project and you can sell into them. But that, again, is a big assumption. So, it kind of brings us to the Aussie government. And are they going to be the ones on the hook for putting up an offtake agreement and buying this after they wrote the massive loan? I'm not sure if you guys have thoughts on that, but it's a delicate situation, right?
This is a big head scratcher. How do you draw down your debt without offtakes in place? When it comes to niche commodities, you need an offtake that has some degree of comfort for the financier, which usually means it's got to be the price link, price floors, or something like that, right? Financier is not going to be comfortable unless you've got some degree of certainty around what your price is actually going to be on this. I don't see where they're going to be able to get this offtake from. But I have I've been putting together some dots, and this is part of the reason I get sick in my stomach about what could really be going on here.
Run us through it.
The whole financing case is based on bifurcated markets by not selling to China. So what they assume these long-term Adamus like forecasts of NdPr, which is like 3 times the current spot price, thereabouts of NdPr, which is like, go figure. But I'm not sure if you read the news about the change in the future funds mandate a few weeks ago, JD and Ali, but this was like a pretty divisive topic. The future fund, Australia's sovereign wealth fund, it's supposed to be, kind of changed its mandate to include funding national priorities, including building more housing, supporting the green energy transition, and improving infrastructure. And while that sounds a little bit innocuous, this is a big deal. And it was understandably kind of divisive because of the perception the money gets to go towards potentially uneconomic kind of pet projects of the government of the day. And a few months before the future funds mandate changed, I had someone give me a call, and they told me something that they'd heard on the grapevine or word on the decline. I even put it in word on the decline in our daily email a few months ago. But what I was told is that a vehicle is expected to kind of pop up backed by money of the future fund, which will explicitly underwrite the offtakes of rare earth projects. So the future fund potentially agreeing to underwrite the price and volume of production to come out of presumably Eneabba and potentially other facilities to enable kind of that financing case to be comfortable at potentially absurd prices that could be up to 3 times higher than whatever the prevailing spot price is for product in China, assuming that the green premium emerges in the West. It's just a kind of baffling proposition, don't you think?
I could not agree more. And it becomes a mechanism for one government entity to sort of save the potential embarrassment of another one because they've made a hugely uneconomic bet. And it brings about the question, should the future fund be completely separate from the government, just like a central bank should be? Or is it going to be used for the government of the day, whoever that might be, to fund any sort of project at their whim that they want? And it sets off massive alarm bells because the future fund is, it's the money of the Australian people. It should be invested in the future for the best return possible for the Australian people.
You'd hope you get a fucking compound interest return on that, not just throwing it at things that
punting it.
Anyway, this is still word on the decline that this would happen. But if it does come to fruition, I'll be particularly fucking pissed off, mate. As a taxpayer, what a fucking joke. If it sees the light of day, though, it sort of would explain why Iluka may be so adamant about pushing ahead with the project. I think they've sold off 10%. I think a lot of the rhetoric and commentary about it is this project's uneconomic. Why are you pushing ahead with financing it? It makes no sense, right? And
do they know something we don't?
Do they know something we don't? Iluka isn't run by numpties. Iluka's directors for decades have had a lot of connections with West Farmers, right? Tom O'Leary, the current CEO since 2016, ex-West Farmers. And as we can see reported in the West last week, West Farmers are even exploring for rare earths in the goldfields themselves. None of this capital allocation makes much sense. And Wesies pride themselves on being best in business at capital allocation. It doesn't make sense unless you have high conviction about the government underwriting higher prices, hence underwriting their downside.
The thing, the thing that sort of confused me about all this, and I guess a bit of a question I like to put to you two is, everyone's always banging on about, Australia needs to, invest and develop its downstream, capabilities and industries and things like that, which will inevitably involve some sort of, government, assistance or incentives or in some sort of form. But then you're trying to reconcile and balance that with, as you guys have talked about, sensible capital allocation. If this is not the right way or the best way to go about setting up these industries and investing in these industries in Australia, how else can we do it? Is there other ideas or ways we could go about it?
This is it's almost like a picking winners strategy, right? And I think the way we've spoken about it in the past, which I sort of stand by is setting up the infrastructure if you are going to allocate the capital to have, it be to the benefit of a market-based sort of system that can still sort of allocate capital effectively, as opposed to just allocating $2 billion to a project and saying, here you go, try and make it happen. That's in a nutshell how I kind of think about it.
The price mechanism is a tremendous tool at filtering what is and isn't financeable. And do we want to distort the price mechanism? Well, guess what? We're going to end up regretting that with taxpayer money. Like, to your point exactly, there's two things that we could do, and we had a conversation like before turning on to these exact 2 points. Number one, why would we be uncompetitive in this industry? A huge part of it is our nonsensical energy like landscape in Australia and Western Australia. It's baffling. It's bizarre.
East Coast, no exception.
East Coast, no exception. We should focus on an energy abundance that actually gives us a competitive downstream industry in the first place. There is no way we would have a competitive downstream industry in Western Australia with our cost of energy. Unless you focused on energy abundance, all forms of energy, and reduced the timelines to make that happen, real capital investment in energy projects, then say goodbye to that proposition. And the other point is on creating the settings that enable the private sector to make its own investment decisions which stack up on its own merit. What does that look like? Well, an example is what Indonesia's done with Morowali, right? We had 53 joint ventures there. They provided a special economic zone which enabled tax breaks for a tax holiday of 7 years. That encouraged phenomenal capital investment to really build out a downstream industrial sector there, which it's just got that's the private sector moving. The private sector is looking, okay, the settings are right for us to make investment decisions in this area. You saw that in what Rio Tinto and both BHP have talked about investing in Argentina in the last 6 months. It's the policy settings in Argentina that are very attractive right now, hence why they're comfortable investing in that jurisdiction, that country. We've got the exact opposite situation in most of Australia. It's completely unattractive to commit significant private capital for projects when you have uncertainty, high cost of energy, tax regimes and royalties that keep going higher and higher. There's no incentive for the private sector to come up with its private projects that stack up on its own merit. Focus on that, and you'll have an abundance of competitive projects that all want to come and invest in do their own thing. But if it doesn't stack up on private metrics, then you just limit yourself to perpetual subsidization of something that will never be competitive in the long run. That's not good for anyone. It's should the government pay people to just dig a hole? No, it's got to be productive.
Yeah, agreed. The money's got to come somewhere at the end of the day, and it comes from the taxpayer's pocket. So to continue on with that and to make it, draw it back in with Iluka and the project, we should provide the economics and how they kind of stand in the scenarios that the company is given. There's a few really important pieces here. So obviously you've got the price assumptions. Then plant utilization. It's different under each scenario as we've been through, but that is a super, it's a high sensitivity aspect of whether the economics stack up here. Mm-hmm. And commissioning, another one we'll touch on in a moment. We'll start quickly with the revised economics as Iluka sees it and just read out a couple points. So they're using an 8.25% discount rate. You've got two broad scenarios, pricing scenarios, that is. The first one is this Adamas one, which we've commented on a few times now. They are a price forecaster, and by and large, they are higher prices than the second scenario, which is the 10-year average price. So just quickly, under scenario A, you've got $1.7 billion. Under scenario B, you've got $3.3 billion. And under scenario C, you've got $870 million. Then under the 10-year average price assumption, the economics fall back dramatically. You've got $650 million in scenario A, $1.9 billion in scenario B, and $230 million in scenario C, noting that the scenarios exclude the $320 million that have already been spent. So they are MPVs from this point in time, not taking into account the sunk capital.
What's been already done.
Yeah.
And to be clear, all these scenarios now include the processing of monazite concentrate from Balranald as well?
All of them include Balranald as well, Ali. Yeah.
And Balranald isn't your usual kind of mineral sands mine, is it, Trav?
It's actually it's like different to your conventional mineral sands operation. The norm is like surface mining. You see that a lot, like Cannabis down south. The other common type of mining is dredge mining with mineral sands. Like Tronox does a fair bit of that over east, for example. But Balranald is neither of those two. It's actually quite a lot higher grade than the typical mineral sands project that comes online these days. But that's because it's underground. It's an
right.
underground mineral sands mine.
Geez, you want to make sure they've got some Sandvik Ground Support all over that joint.
I would have thought so, Ali. I would have, but the mining method is it's a bit funky to what we're used to talk about. I'll read this from the DFS. It says a novel internally developed underground mining method utilizing directional drilling technology has been developed. It says underground mining will use a mining unit plant (MUP) and ancillaries, mobile mining plant (MMP), and subsurface equipment. So you're not like using a jumbo kind of thing, Ali. It's these big kind of bulks processing infrastructure, but you could be onto something, I think, because I also read this bit in the DFS. It says an area of poor geotechnical conditions has been identified in a geological zone above some sections of the ore body. Mining this material during T3 proved problematic, and it's estimated that only 30% of ore was recovered in the trial. There's also this bit here I read too. It said stopes are designed with 1 metre pillars separating each stope every 10 stopes. Make a panel with 1 stope left in situ for ground support between each panel. Geotech issues leading to poor ore recovery. In situ stopes for ground support. If anything can fix that, Ali, you know what can?
It's Sandvik Ground Support. They can do it. It's in the name, literally ground support. I mean, and then now they've even got that new odor-free resin that Maddie's been telling everybody about. How good's that?
Excellent points. It's not just mesh and bolts, Ali. Injection resins and foams, mineral products for rock reinforcement, resin capsules and other chemicals.
Love it. Hit up Derek Hurd from Sandvik Ground Support. Get one more Sandvik order in before Christmas.
Go
Cheers.
Sandvik.
Thanks, guys. Cheers, Derek.
Alrighty, so we've got to talk a bit more about pricing. This is a super, super important detail. Rare earth prices are very depressed at the moment. No secret, you listen to any Linus call or Iluka call for that matter over the past few quarters, past couple years now, and you hear it all the time. So Iluka have been encouraging everyone, they said it again on the call on Friday, to actually contract with buyers. Now that kind of gets back to the green premium and all these sorts of things that we've touched on already. But for those that don't follow rare earths closely, it's a highly, highly manipulated market. It is dominated by China. We're talking 90% China dominated. And the NdPr price right now is about US $58 last time I looked per kilo. That includes VAT. That said, you've got to make a price assumption when you're putting out a study like this. So at current prices, Eneabba does not make any money. And the question to ask is, how do Iluka have the confidence that they will receive an economic price so that they can, make FID or continue building the project? And I know they're getting a very, very friendly loan, as we've touched on, but they are still putting hundreds of millions of dollars on the table here. And, you hope they're not suffering from any sort of sunk cost fallacy. I should say we rather, and I really hope we're not suffering from any kind of sunk cost fallacy here. And I use the word we pretty deliberately because our government, again, is contributing hugely. Taxpayers should be asking the question, is it right for Australia to write a cheque of this sort of magnitude? The life of mine NdPr price assumptions for scenario A and B are US $148 a kilo. Bearing in mind, I just said $58 is where we're at right now. For scenario C, it's US $129 a kilo, but that is more than double, nearly sort of triple from the prices we're at. And as we kind of touched on, maybe the company pulls a rabbit out of the hat. It's very hard to see in terms of an offtake. I just don't know where that kind of comes from.
How does assuming like those prices, long-term price assumptions, how is it a financing case to assume prices bifurcate? Like, how is that a financing case? Who's making these decisions? It's just like, it's nonsensical in my opinion. I think the only reason they can do it is if they have line of sight to the government underwriting the offtake.
You'd just love to be a fly on the wall there and hear whether they actually seriously spoke about not going ahead with the rest of the build. $320 million has already been spent. It's not a negligible amount of money. It's, it would be to the detriment of Iluka as well as the taxpayer. But you don't really get the impression that that was seriously considered at all.
There's just so many like assumptions on assumptions on assumptions here. Like a lot of things have to go right, and who knows? Maybe the rare earths prize will get there one day. Who are we to comment or know that it's? But the thing
That's
is,
not
it's
your
like if you
financing
can't-
case. Like,
But it's to use that as your sort of base case price, in a model to make a decision on this, where I don't know if you'd call it spot, but perhaps the whatever the current prices are today, it makes you a bit nervous, right? And that's yes, they've got this extra money in the door, which okay, that's all lovely, but all these projected economics and things like that are still on the basis of these prices 2 to 3 times where they are today, not as at today.
100%. Your base
Which
case
makes me
scenario
nervous.
is double. It's double. And the analysts were really touching on this in the questions they were asking. So Glyn Lawcock from Barrenjoey, he asked some great questions, and he was really quizzing management on these points, sort of getting at how long is the market going to be in the dark on whether this project makes money, i.e. when are we going to get an update on the offtakes. So, if you look at the analysts, what they've kind of said or what they're reporting, Eneabba is carrying a negligible or negative in some cases value in the NAV assessments that a lot of the equity research analysts have put out, and
that's even including the generous concessions. They're basically saying,
including
the
them.
NAV to Iluka per share is negative.
Yeah,
Like,
and the long-term consensus for a lot of these analysts is $20-30 higher from where we are today. So let alone at what spot is right now, and
But still a fair bit lower than what seems to be assumed.
than what the company has assumed.
yeah.
Yeah, that's right. And the company, again, they'll point to this growing market. They put a number of slides in the presentation comparing 2024, the size of the market, to 2035. They spoke to this in the Q&A. Again, like you said, Ali, another big assumption to just assume that the market grows to this very, very big level. And, you're banking on massive EV adoption and wind turbine adoption amongst the other, uses of these magnets. And I mean, forecasting anything 11 years out is, it's almost a mug's game, right? It's super, super hard. Like forecasting commodity prices is very hard. That's why we look at where we are in the cost curve and in the cycle. And you can't really do that with this stuff because there's not really a normal cycle.
Very tricky.
Because it's so manipulated. So, again, I think we kind of come back to the point. Maybe there are details, and maybe we're talking way out of school because there's things we're just not privy to. Maybe there are agreements that the company has come out with,
even if that's the case, like it either makes no sense from a capital allocation perspective from Iluka, or it makes no sense from a capital allocation perspective for the taxpayer. Either one, you got to ask questions like, what the fuck's going on here?
Yeah.
And if the government does kind of underwrite it, or the taxpayer underwrites it, maybe that's because they can underwrite. They've got these agreements to distribute these strategic stockpiles to the West, and this is going to be the source of strategic stockpiles of like an NdPr oxide. Like, and there's your bifurcated market. Yeah, great, thanks, cool.
Yeah.
How about telling that to us? Like it just not. There's a lot to be filled in here.
That stockpile point is one that comes up and up and up, and it's something the Chinese have done, very well. They've been great over the past 2 decades at just hoovering up commodities when they're at lows. It's not the situation here. It's not really how it's been pictured. You wouldn't be scooping up prices when they are super low. The Australian government would almost do better to just go and buy them now if they can, because they'd be getting them a bit cheaper. So, yeah, it's a super interesting one, right? And it's even more fascinating in the context of the news in the past week or so with gallium, germanium, and antimony again. Making headlines, just highlighting that these byproduct minerals are strategically important around the world, and China with their ideology will use these as utensils, as sort of pawns in a trade war. So these things are important, but I'm not sure from the perspective of an ASX listed company pressing go on a project like this with these sorts of assumptions makes complete sense to me.
I think the other point we should really hone in on is just like the assumptions on commissioning. Like JD, this is an area where there's a tremendous amount of risk in the spreadsheet. Like not just commissioning, by the way, but also just your capex blowouts. So it's the capex already blown out. Like these projects absolutely renowned for more and more capex blowouts. Wouldn't surprise me to see that blowout again. And what does that do to your economics? Kills it. But on commissioning, you guys know about McNulty curves.
Oh, geez, it's been a while since we've talked about them. Give us the rundown, Trev, for those who aren't familiar with those.
McNulty curves in mining ramp up, they're used to model like the time and efficiency required to bring an operation from kind of like the point it starts when the plant's turned on into full production. Like how long does it take? So like ramp
and
up,
importantly, the steady state you get to
how long does it take to get to nameplate, right? Like ramp up typically follows this sort of like sigmoid S-shaped curve, starting sort of slowly as equipment's tested in that commissioning, and then and processes are refined, sort of accelerating as efficiency improves, and then like eventually kind of leveling and tapering off at a steady state, like you talked about, JD. These McNulty curve, they plot the time from the plant turning on versus the plant output percentage of nameplate on the y-axis, and the research on these McNulty curves kind of categorizes them into 4 types of curves. Type 1 curves model the ramp up of well-established processing facilities in locations where the technical expertise is abundant. It's a well-trodden path. People who know what they're doing are doing the job. And then you can expect these type 1 curves. Think conventional kind of gold plants in Western Australia. So you ramp up pretty fast to nameplate, honky dory. It's happy days. Then type 4 models the ramp up of complex processing techniques for advanced commodities or processing in regions that also do not have inherent technical expertise in these areas, and built by contractors who maybe haven't built something like this before. Think the lithium hydroxide facilities in Western Australia. Type 4 curves are still in ramp up in year 3, and they're still in ramp up 3 years after the plant turns on, and they never actually get to the nameplate number they were supposed to. They get to like far less of that. Over time, processing methods and plants, they can become better understood, and a curve that was once a type 4 can become a type 1. That's what happened with HPALs. The first generation of those HPAL plants, think the ones in WA, Ravensthorpe, Murrin and Caws, Bulong, they were type 4, big disappointments. But the Chinese built on that technology over decades. They got much better and efficient at building them, and that's what they built in Indonesia in a phenomenally kind of efficient manner on tight capital budgets, and ramped them up super fast. So now you can say HPALs have a type 1 curve. So apologies for waffling on about McNulty curve so much, but if Iluka's spreadsheet is assuming anything other than a type 4 McNulty for Eneabba, they are kidding themselves. This is like the most advanced, stuff when it comes. Like everyone says rare earths. This is the most challenging, like metallurgically challenging, like chemistry set stuff that there is in our industry. This is super advanced, and what they're going for is the full vertical integration shebang. It's not just the cracking and leaching bit, which Linus has done in Kalgoorlie and is struggling with big time. But they want to build a hydromet plant on top of that, which is like, compounding the complexity in a lot of ways. So I just think what happens here, if inevitably ramp up takes way longer than expected, and so the interim working capital is massive. Like the capex blows out to $2.5 billion plus, and it takes, what if it takes like 6 years and you're still not at nameplate? Like who's on the hook for that, right? Like does the taxpayer keep underwriting more advancements because otherwise the economics don't stack up, or does it leave Iluka in a precarious situation? I think that's why the stocks come off. It's just like people are running the ruler over this and just thinking, like, what are you doing?
So I think the TLDR version of what you've sort of gone through, Trav, is what I'm getting is essentially it's naive. It's not to say that it can't be done, but it's naive to think won't be without its complexities, challenges, potential cost and time blowouts and things like that. So it's just important to keep that in the back of your mind.
And because the government has picked a winner, like when you have the timing and capex like blowout, like I think Snowy Hydro, does that mean the taxpayers on the hook for that? Like again, like I just think that this is the where things get really like dubious, in my opinion, by picking winners. Like create the policy settings that encourage private investment. Don't pick winners. It's just fucking it's an easy point to make, but it's also a very like easy philosophy to bring to the table when trying to like address these complex problems, I think too.
And recoveries was one of the other assumptions you guys flagged as well to have a look at. Yeah,
I mean, credit to Rare Earth Observer for this one, but it just hammers home what you've said there, Trav. And I mean, maybe it goes one step kind of further. The company gave this worked example on just the Eneabba stockpile feed scenario, and it's just a sort of simple 90% recovery assumption. That implies 90% overall, i.e. 90% after processing, after cracking, after leaching and separation. It's not 90% at each step of the way, because that would be 0.9 times 0.9 and so on. It's 90% all up. That is a big assumption to make. Again, to your point, Ali, just another assumption. And yeah, coming out the back of this, we probably sounded pretty critical. I'm sure Iluka is well aware of the challenges. They would understand this. I mean, it's very interesting from their perspective, because that they have gone from just the go-to mineral sands play with iron ore exposure through their Deterra shareholding to now a kind of convoluted, mineral sands, iron ore, and this wacky big rare earth thing. It makes their investment proposition, as a complete sort of side note, a whole lot different. And who knows what their shareholders were, or what they kind of think. I mean, some of them voted with their feet last Friday, what they think about that. So I'm sure some were hoping that this would have just gone on the back burner and they would have called this Eneabba foray a bit of a day, but it's not been the case, and some of them have left now.
Notice what they're not willing to part ways with, JD. So they own 20% of Deterra. The dividends from Deterra, they pass straight through to their own shareholders. So the dividend that Iluka pays is basically what they're getting from the Deterra royalty that they still own. And they're not willing to monetize that stake because
too expensive, they said.
Well, whether it's too expensive or like think of what happened. There's a lot of shareholders hold stocks in Australia, superannuation funds, blah blah blah, fully franked dividends, happy days. So you get rid of that. Where's the cash flow in this business that actually goes back to shareholders? Like it's not there. It's absent for a very long time. So like I think what happens to your share price if you got rid of that is the more unnerving thing.
Completely agreed. And yeah, I think that's enough said for that one.
Wow, I've learned so much about mineral sands and rare earths today.
Best way to learn, Ali? Just to immerse yourself in it. Huh?
Absolutely.
Alrighty, we've got a couple partners to thank. Thank you to Mineral Mining Services, Grounded, Sandvik Ground Support, who we had in the show, CRE Insurance, K-Drill, Daishsat, Saltbush Contracting, and Get Wet Solutions. Hoodaroo, guys.
Hoodaroo.
The information contained in this episode of Money of Mine is of general nature only and does not take into account the objectives, financial situation or needs of any particular person. Before making any investment decision, you should consult with your financial advisor and consider how appropriate the advice is to your objectives, financial situation and needs.